using a high cash value life insurance policy really as a bank. Specifically here, we are focusing on dividend paying whole life insurance and maximizing the cash value component of policies. But this idea, using a life insurance policy as a bank or practicing the banking function, is quite popular. There's a lot of different names out there. Really, it all comes from Nelson Nash and the infinite banking concept. He is the guy that started it and branded it. And then we see a million other names out there that pretty much do the same thing. Maybe they have their own spin on it, whether it's cash flow banking, bank on yourself. There's a lot of different names, but what it all revolves around is the idea of using a dividend paying whole life insurance policy as a financing tool. So how does it work like a bank, right? If we're going to practice the banking function or just park money there, how does it work? Well, there's really two components. Individuals we work with typically fall in one of these categories, and sometimes it's both. We have the cash value asset itself, and then we have the banking function. So to start with a cash value asset, a life insurance policy at its core, if we structure it right, optimize the cash value of the policy, it is a safe, secure, liquid, tax-free area to position money with strong guarantees. Now, I did mention tax-free. The policy's got to be set up right to ensure we don't trigger a taxable event there. But if it's all set up right, we've got a tax-free benefit. We have a guaranteed floor, often a 4%. Very liquid, meaning we can access the money. And then we have the safety as well. So the money is never tied to or invested in the stock market. You'll see no matter what happens, one's cash value continues to appreciate over time. Okay. Then we've got the banking function. And this really teaches one or revolves around the idea of using a whole life insurance policy really as a financing tool. So the idea here, financing with the cash value in a life insurance policy instead of going to a lender, instead of an institution. We're taking control of this banking function and using it ourselves. Our money stays at work for us. What that means is once a dollar passes through the cash value of a whole life insurance policy, regardless if we just let that dollar sit and grow, or if we borrow against it, if we pull the money out, it continues to stay at work for us. We're going to see an example here. Excuse me. And then really with that, we can use the policy for purchases, whether that is real estate, paying off debt, if I'm investing in my business, whatever it might be. So let's touch on this piece first, because what I'll often talk about is, hey, how do I optimize the cash value first? Because if I've got more money and equity in the policy, short-term and long-term, that gives me more money to work with than to practice this in turn. That's really what I'm after. So nice spreadsheet here. We put a lot of returns and such because I love that stuff. So what we've got here is a policy on a 35-year-old male funding for a short period of time. Now, what I'll say with a whole life insurance policy is you can design a policy where you can literally pay into it your whole life. However, we're going to stop here in 5 years. I like demonstrating that for the reason that a lot of times people hear the word whole life insurance and they think, I got to pay my whole life. And then we see, wait a minute, I can fund for a short period of time and keep going if I wanted to, but I'm not required to do so. It's a neat concept when we look at it. But here, what I want to touch on, so the cash value asset itself. So what we ran here is one product with one company on this 35-year-old male, but different crediting rate assumptions. The first thing on the left we have is the worst case scenario, guaranteed values, gross crediting rate of 4%. Anytime you see a guaranteed rate or a dividend for that matter with any insurance company, always keep in mind that is a gross rate that is credited after the insurance company's expenses and mortality charges. So we see the cash value accumulation. I pay in 50. First year, I've got just about 45. By year 5, I've broken even, again, based off the guarantees here. I pay nothing in. Cash value continues to accumulate. Okay, that's great. Then I've got my annual IRR, which represents internal rate of return, and then my average IRR. Now this average is a little overinflated. It's going to top out about 2.5, 2.6. The reason being has to do with the insurance product. It used the guaranteed rate, but it used the current term insurance expenses where we made this worst case scenario. I'm getting into too much detail. If you have questions on that, reach out. All right, so let's keep going here. So annual IRR and average. The annual represents what I am earning year over year. So that particular year, if I'm going to say, hey, I earned 8% in the market this year, or the S&P in 2019, S&P 500 did just about 30%. Well, if I want to look at a specific year, you can do the same thing with a policy or any asset for that matter. So this shows, based off the worst case scenario guarantees, the policy tops out a little over 3.25, 3.34 at its height year over year. Now the average will be lower because that's going to factor in really the first year, the early years where I'm negative. So the annual is going to pull it up, but overall, 2.8% on the average based off the guarantees. You know, where that's so interesting to me is a lot of times we hear reviews about whole life insurance where it does 1% at best. This does demonstrate the structure and the design of the policy. Yes, this shows 50 grand going in per year, but this would be the same if they paid in 10 grand per year if the structure, if the design is consistent. So you might say, okay, 2.8% or even 3.3 over time, isn't that great? Two things on that. It is a tax-free yield. We're going to look at a comparison to taxable next. And also, we are assuming absolute worst case scenario with the guarantees, where we've always seen it do better than that. Then we have a conservative dividend rate, 4.825. Then we have a dividend of 5.65. And then we also have, with this whole life product, an indexed feature where we can index the dividend. We can switch back and forth between the basic dividend and the index. Some people like it, some people don't. If anyone attaches it, we usually put it at 0, which is the exact same thing as if you didn't have it. And then you can flip it on years that maybe the market tanked or something like that. But what you'll find here, so this again is touching on the cash value asset. So if we go back to the whiteboard here, we're focusing on this piece right here. Safe, secure, look to the guarantees, liquid, we're going to look at that in a minute and tie it to this piece, and the tax advantages. We're going to look at that too. All right. Go back to our spreadsheet. So again, this is just showing ways to optimize the cash growth. Again, the more equity we have, the more money we have access to use. Let's take a look at this. So, you know, kind of on this point, the idea of using it like a bank or so, where I've talked to individuals and they say, you know, I like this idea of a life insurance policy because it's kind of like a bank. I can put money in there and have it actually earn some interest for me and still have access to it, which is true. I mean, frankly, a bank account, even when we look at the guarantees, is not going to give you 3.3% year over year. Now, what we've got here are taxable equivalents. Okay, so taxable equivalent. What this means is we ran here a 28% tax bracket, meaning if the individual was in a 28% tax bracket, what would he have to earn to get the same tax-free equivalent in the life insurance product? So, for example, we looked at the worst case scenario, guaranteed values, and then the opposite end of the spectrum with the best case scenario, that index feature. That way we don't have to try and cram them all on one page. So if I look at, let's look at by the time he's 50 on the annual IRR, it doesn't really matter. 3.34% is what he earned on the guaranteed values. He would need in a taxable investment based off of a 28% tax bracket to earn 4.64%. Meaning a 4.64% yield after tax nets out to that 3.3 and change. Same thing with the averages here. Now when you look at the stronger yields, it's all relative. tops out a little over 5%, which would require between 6 and 7%, over 7% annually, and then 6% via the average. Can you do better? Possibly. And I mean, I would never suggest one look at a whole life insurance policy instead of another investment strategy, or instead as a property purchase or putting money in the market, whatever our thing is. I always look at it as, how do I enhance my present situation with this? If I park money or have money just in cash or something like that, great alternative in that respect. So a nice taxable equivalence here. Let's take a look at using the money. So again, now we're going to look at the banking function more so. So money stays at work for me, right? I want to use it as a financing tool here. There we go. Unique feature to a policy. You saw that growth over time, the returns based off the different assumptions. Once that money's in the policy, regardless if you let it stay there and grow, or if you loan against it, if you borrow against it, you continue to receive compounding on the entire bucket of money. A lot like real estate, right? If you own a home free and clear, or if you have a mortgage out against it, if it's appreciating the appraisal value at 5%, you're going to get that in the entire home, regardless if you own it outright or not. So money continues to stay at work for us, and let's use it for some purchases. What do we want to buy? For 200 grand, what do you want to buy? Let's say we buy a piece of property, or we invest in our business. We clear some student loans. Maybe it was from med school or something like that. So how do the loans work? I'm using it as a financing tool. This is based off of the basic dividend rate. So one of the middle of the road assumptions. Here you see the annual and average IRRs. That is that tax-free yield. We did not put the taxable equivalent on this sheet. But here we go. I pulled out $200,000. What is the impact of that $200,000 coming out of my policy? Your cash value is your equity. So look at this, $70,000 in cash. Compare that to the example where I just paid money in and let it sit and grow. What do I see? Just about a $200K reduction. So the cash value, again, that's the equity, the gauge that determines how much I can pull from the policy. Now, the nice part is the company is going to continue to pay dividends on any money in cash value and the money we loan, we borrow. How and why they do that, because this question comes up quite a bit. Why would an insurance company do that? One, they do charge interest on the loan. Just like if I take a mortgage out with a bank, they're going to charge me interest on it. And then two, the source of collateral is the death benefit. We borrowed $200,000. How much did your death benefit drop there? Dollar for dollar, $200,000. So really what the insurance company collateralizes is the death benefit. Remember, as a life insurance company, what is their first and foremost obligation? Pay life insurance claims. If we die with a loan outstanding, that means they're in the hook for that much less. Okay, so here we borrowed out that 200K, and in this example, what we illustrated here was repaying the loan interest every year and started attacking the principal the year after we took a loan. So the first year we made no principal payments, interest only. In reality, when we take a loan from a policy, we have complete control. Whether we sporadically pay it down, never pay it down, provided the policy doesn't lapse. A lot of times during retirement, people will take income through loans and not pay them back. Tons of control. But here, we are going to repay it because I want to illustrate how the policy functions here, is loan interest payments. There's the interest when we pull that 200K loan out. We paid that out of pocket. Loan interest payment. Following year, we paid the interest again, but the balance as well. In light blue, we've got our total out of pocket. So obviously, as we throw 20 grand per year at the principal of the loan, we're chipping away at the balance. here's your loan balance. As a result, less interest accrues naturally. Here's the main thing to look at. When your cash value, when that loan is paid off, what do you notice here? The cash value and death benefit. A little bit stronger on the borrow and repay example. That has to do with the direct recognition treatment. They credit us a higher dividend on borrowed funds. Not going to get a whole lot into detail on that. Point being is we took that 200K out. Perhaps we used it to invest in property or in our business. Maybe that was producing 8%. If it was our business, maybe it produced 80%. Our business is usually our best rate of return. Point being, money stayed at work in here, kept on compounding, while at the same time we leveraged it to yield a rate of return elsewhere. Yes, we did have the loan interest expense as well. Always good to disclose that. We could take this several steps further and see how much am I actually earning on my business, my investment, debt pay down, whatever it might be, to crunch the real numbers. That stuff is fun. But overall, this is a nice way we can use it as a financing tool. So, nice alternative to having money in a bank. Now, we should definitely still keep money in the bank, some of it the emergency fund. We do have access to money. It's very liquid here. We can get to it any time. When we request a loan, typically we get it anywhere between 2 and maybe 5 to 7 business days. Call it 2 to 7 business days. Depends on the company and if it's ACH, that's direct deposit, or if they mail a check. But with that said, some insurance companies, when you actually read the contract language, which is fun to do, can hold a loan request for up to 6 months. I've never seen that happen. Even when we look at policies that live the test of time through serious economic turmoil, the depression, has that happened? I haven't seen it happen, but contractually they reserve the right to do so. In 2008, it didn't happen either. But it's good to be aware of that. So why I mention that is I don't want to put everything in here. I do want to keep money in that short-term cash reserve. Rainy day happens, I'm good in that respect. But anyway, hope this helped kind of from a concept standpoint. I know we blended the life insurance in there as well. If you have any questions, reach out. If you'd like some custom proposals or policies, reach out. And I hope this helped. We'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.